All right, this is week 8, week before spring break, and it's time for our midterm covering. We've gotten through looking at it from a broad scope, the entire 1040, which also included the Schedule A, the itemized deductions, and if you counted Schedule B, listing any interest and dividends that you had earned, as long as they were over $1,500, either one. So what I brought up on the screen now is the class sessions week 8, just remembering to highlight here the due date. Remember, for the original exam, since this does abut with spring break, the midterm and campuses will be closed. The midterm is due by this Saturday, the 7th, so I'll send out an announcement about that as well. And then I give you the full time to complete part 2, which I will briefly, we'll go over a little bit of that too today during this lecture. Again, this will hopefully will go about 45 minutes, and you'll have a good sense of what will be on the test. So the exam, the midterm, will be in 2 parts. Part 1 you do take at your local campus, the one that I have sent your proctor forms to, and I hope by now you have scheduled an appointment time. Part 2 you can do any time you want at home or anywhere that you have your Acct software, as you will be completing a tax return and then answering some questions like we have done so far in class throughout the year, and taking what you have in the Acct software and then being able to answer some of the questions that I've presented. Also, I just wanted to bring to your attention this extra credit opportunity about our VITA program. That stands for Volunteer Income Tax Assistance. And what that entails is you go in and watch the presentation that a group of students and I put together a couple semesters back, and then answer some of the questions in here in the assignment and assessments folder. What I'm going to be looking at, I'm going to be pulling up is I have opened the review document. We're going to be going through that. Also the online directions, just a quick kind of what I'm doing now, but we'll look at that. And then this VITA presentation questions, in case you want to answer the questions as the video is going along and not necessarily answer them in Blackboard, that's what I have this here for. Now they're kind of out of order from what I have. Well, no, they're not. I guess I have them in the right order. Okay, here again, I can't stress it enough, midterm part 1 is due by Saturday. Whenever your proctor center closes, they could close at different times. And then part 2, you have until Tuesday, normal 8 a.m. if you so choose, on the 10th. The extra credit, you're going to go to this copy and paste this YouTube site. This is this takes you to my channel, my YouTube channel, where I also have, and I don't know if you'll be able to see it from this site, but if you are ever interested, I have all of my Accounting 101 lectures on there. And a lot of students, if they ever miss class, they can go to my YouTube channel and watch whatever week they missed or class session they missed for Accounting 101 or any exercises, which hopefully you would find helpful for people in Accounting 101. So midterm test 1, this is proctor. This is password protected, so you won't be able to get in here until you get to your proctor site. Midterm part 2, notice I do have all of the information already out here ready for you. And again, I'm going to go through some of this just a little bit. I believe that's it from here. Let's go ahead and bring up I'm going to bring up the online directions first sheet just to make sure we covered everything about getting the exam ready to go. So here I talk about it being in 2 sections and sending it where you had already told me you wanted it sent from week 1. One big thing here, make sure you are aware that I do allow 1-page notes. Front and back is okay. In tax, there is so much laws to remember. I don't expect you to remember everything. I want you to know the high points, definitely. Some of the most important things that we're going to look at in the review document. And if you have good notes over the review document, you should do pretty well on the exam. Again, due dates, calling ahead to your campus center to make sure you have an appointment. I know here at Region 6, in Anderson and Muncie and Marion, you do need to have an appointment. Do not wait until the last minute. No makeup. Okay, I'm going to get out of this one. You can read through this one again to get any further details that you might need. But let's go on to, I want to kind of go in backwards order. We're going to do the review in a minute, but let's first look at the tax return that I want you to be able to complete. This is the Word part. It tells you everything that needs to go in the tax return, and then the second attachment in that Blackboard class sessions are the PDF tax documents, like the W-2s, 1090. There won't be any 1099 miscellaneous, but 1099 interest, dividends, and any other forms that were needed that I didn't necessarily just type out here. So part of the first part is deciding who, if any of the people that are associated with the Fox, with Michael J. Fox and Tracy, are allowed as dependents. All of them could be, maybe none of them, or some of them. Give you some a lot of good information about, here's all of the information that's in the PDF files. We had a life insurance policy, and then Tracy going back to school and completing her degree. Assume again that she never had any felony for possession of controlled substances, as that's one of the questions that it asks you. Go back and make sure you remember how to do total tuition paid minus the free money and your refunds, and we'll briefly discuss on that as well in the review document. I've got a little bit of contributions and the part where we donated artwork, exactly what items you should be filling in when you do fill this in. I forgot to mention up here with the John has his internship program, grad assistant program, $10,000 he's earning. The child here, Mary, has some daycare, and Harry Fox has some Social Security benefits that he received. And then a few other miscellaneous items here that will need to go into the tax return, or you need to decide if they need to. Not everything on here will definitely go in. Some of it will be extra information. And that's part of what being a tax preparer, a good tax preparer, is all about, is being able to sift through and deciding what does go on the tax return and what doesn't. All right, now, so you're going to fill all that in and go into the testing area, go into Blackboard class sessions 8, week 8, and then actually fill in the answers. And I'll probably have you attach the tax return as well, in addition. So if I see you miss something in the multiple choice or the answers, I can go into your tax return and see why. Okay, now going into the review document. Again, I tell you, and we're going to go through this in more detail in the next week or two after spring break. But if you go into the syllabus and near on the front page, I give you a link about the text and what's needed, and I say other supplemental material, and then there's a link to the VITA site. That link is a great way to study for anything that we have covered so far in the basic section. There they have it. Personal exemptions, what filing status should you be claiming, some different things that you should know about with refundable credits like the child tax credit or child and dependent care credit, earned income credit, any deductions from your income, actual, what can be counted as regular income, what's non-income. All of that is great stuff. I'll go ahead and just pull up the syllabus quickly and make sure to remind you. And see here, page 2 on the supplemental text. Copy and paste this link, and And there's some very good, a lot of good information to go through, a lot of different slides, and they, after about 4 or 5 slides, they give you a question or two to see how well you do know the material on that subject matter. I think it's a really good study. All right, so all the things that I think you should know after this first 7 weeks of class are listed down here, and let's go through them. First thing, I definitely want you to know the differences between all the filing statuses. What has to be met, what requirements have to be met in order to claim certain ones. The hardest one by far is the head of household. Head of household, remember, you have to be related to any of your dependents to be able to claim head of household. So just because you support your live-in boyfriend who doesn't, or girlfriend, and who doesn't make any money or any taxable money, you cannot claim head of household in that situation. They have to be related to you. Although for somebody to be a dependent, they don't have to be related to you. So it's kind of confusing. Definitely something to go back over. So I tell you here that I'm going to give you, like we did in week 2, I'm going to give you 7 situations, and I'm going to explain how individuals are living together, what their relationship status is, and then you're going to tell me, can they claim them as an exemption? Can they claim them for head of household purposes, or do they need to file single? And then on a few of them, I even asked you, can I claim this individual for earned income credit or the child tax credit? So a couple things to let's look at this example then. Tom lives with his friend. Keyword here, friend, not relative. Randy. He's disabled and earns $10,000 Social Security. If you only earn $10,000 in Social Security, you should know by looking, remember going back to Social Security pages in chapter, I believe it was 3, that only earning $10,000 and that was all your income, that would not be enough to be taxable. None of that would be taxed. And if Tom pays for over half the expenses, how should Tom file? Well, Tom can claim Randy as a dependent. He does meet the requirement since Randy lived with him all year, and Randy didn't have over $39.50 in taxable income. We assume the other situation that he is a U.S. citizen. However, Tom cannot claim head of household because Randy is not a dependent. So Tom could claim 2 exemptions, yet he would have to claim single, file as single. Make sure we definitely know the differences between the qualifying child and qualifying relative. There are similarities, there are differences. For the qualifying child, the individual can work as much as they want and earn as much as they want. There is no income limitation, and you can still claim your child. But they have to be certain age limits, depending on if they're in college or not, and if they're full-time, at least one semester in college. So know those rules. In qualifying relative, kind of weird that they don't even have to be a relative as long as they lived with you all year. And the qualifying relative doesn't even have to live with you. You can still claim somebody as a qualifying relative even if they didn't live with you, as long as you paid for over half of their expenses. Lots of little weird quirks with head of household and then your dependent, qualifying child versus qualifying relative. The IRS website would be a good thing to go to. That VITA website, I think, is really trying to figure out the differences. Go back to my lecture notes as well for week 2. Claiming exemptions, okay, that's part of this qualifying child and qualifying relative. What is a standard deduction? What's the difference between that and itemized deductions? Who should itemize? Should you itemize all the time? And the answer is no. You definitely want to itemize when those deductions are more than your standard deduction. And what do I mean by additional standard deduction? Who gets to claim that? That's basically what I want you to know. Who is eligible to claim it, and what our criteria have to be met. I don't expect you to memorize the amounts. I will give you the amounts on the test, and then you'll tell me what the standard deduction is for that situation. The itemized deductions, being able to tell me what are the different categories. Remember, there's 5 or 6 categories. We got the medical, we got the state and local tax deductions that include real estate tax. We've got the kind of just try to memorize them in their order. We got the mortgage interest area. Then you've got the charity, casualty, and theft deduction, and then your miscellaneous deductions. There's 2 different miscellaneous ones. One's subject to 2% of your AGI, and one is not. And do any of them have limits? Definitely. The doctor one, for doctor medical bills, they have to be over 10% of your AGI. Otherwise, you can't use any of it. So when people bring me $1,000 of hospital and doctor bills, I tell them it's pointless for me to even put it in. You're not gonna get any benefit out of it unless your AGI was under $10,000, which most people aren't going to be above that. Then let's see, the next one that has some limits. Charity has a little bit of limit. Has to be less than 50% of your AGI. You can't claim any more than that. But again, as I mentioned in my lecture, I can't foresee many situations where that's ever going to happen. The casualty and theft deduction definitely has some limits. Remember, it's $100 off of your loss per event, not per item, but per event. And then it's got to be over 10% of your AGI, just like medical. And then the miscellaneous deductions have to be over 2% of your AGI, otherwise they don't count any. So those were some of the items that definitely do have some things that you have to meet, or like charity, you can't go over. Gross income, go back to the week 4 lecture, class sessions 4, or chapter 3 in the book. Lots of different things that can and cannot be included. I have a lot of those listed in my notes in the week 4 session. Knowing that interest, both kinds, taxable and non-taxable, this is interest you receive now, not paid out. Interest you received is recorded as on your 1040, both taxable and non-taxable. It's just that the non-taxable is off in line 8B and not showing up as part of your gross income. Ordinary and qualified dividends, you definitely want to put in both of them on the tax return as well. And then knowing that ordinary dividends are taxed just like your normal wages. It's the qualified dividends that get the special rate. What we'll learn after spring break, it's called the capital gain rate. That if you're in the lower income, you have a different tax percentage than if you are in the higher income bracket. Alimony, again, I didn't discuss this a whole lot because Indiana is a no alimony state, so if you stay around here, you're not going to deal with alimony too much. But alimony, in effect, alimony is deductible on your return if you pay it, so if you're from another state. And alimony is taxable if you received it from your ex-spouse. However, child support is not taxable either way, or as a tax deduction. Divorce settlements are a little different, but again, usually those are not taxable until the person receiving the asset, maybe the house or the car, turns around and sells it for cash. Then that's when tax situations will come into play. Know what these forms are, because if you ever go into any type of accounting work and your CPA boss, it says, I've got a 1098E. You should be able to go in with knowledge of what that is. Of course, you hopefully definitely know what a W-2 is. The 1099 INT, that kind of tells you what that one is. Not much to remember in that it's an interest statement or the dividend. But some of these other ones are a little bit, you just kind of got to memorize them. 1098E, well, that's how much interest you've paid in your education. That's how I have to remember it. E for education, and this is when you're paying back your loans and paying interest. There's a 1098T, which is your tuition. Think of that as T for tuition. And that tells you how much you paid in schooling expenses. But again, if you're at like most schools, especially Ivy Tech is one, I don't ever go by the 1098T. I always want to look at their itemized breakdown of their bill to see exactly how much they paid in and what was came in as free money and what was paid in cash or loans. That's very important. So make sure you are familiar with the different forms that we've covered. The 1099 SSA, knowing that that stands for Social Security. Remember we had a question about the different types of deductions and or credits. I had one of these instructor-made questions. Is this a deduction from your for AGI, meaning it's above the line? It's one of those items on page 1 of the 1040, the line being AGI. Is it a deduction after, below the line, which would be most likely an itemized deduction? That's going to be after your AGI. Maybe your standard deduction or personal exemptions would be the 3 main items. So knowing if something is an itemized deduction, it is therefore going to be below the line. And then can it be qualified as a credit, or what is qualified as a credit, like child and dependent care expenses? What is the difference between, let me mention one more thing. Some items can be either a credit or a deduction, and it just depends on which one is better for you or if you qualify for either one. One example is a retirement deduction, and that's only if you put it into an IRA. If you put money into an IRA, you actually have a choice. You could take the IRA deduction as a for AGI deduction, up to $5,000, however much you put in, or you can take the credit. Now remember, if you remember from my last lecture, the credit is very limited on how much you can take, and if you have an income of not that high of a dollar amount, you don't get any credit. So it might, therefore, it's sometimes better if you don't get any credit to take the deduction, obviously. Another one where you could have a deduction or a credit would be your education expenses. You could have a tuition and fees deduction, or if it's better for you, the lifetime learning credit or the American Opportunity Tax Credit. Definitely knowing the difference between a refundable and a non-refundable credit. The refundable credits are higher up on the back page of the 1040. Those can only take you to a tax liability of 0. After that, you don't get any more benefit out of them. So therefore, if that was the case in this example up in 11, where you had a credit but you didn't have any tax liability to take it, you might as well take it off of your gross income. Therefore, have a lower state income. Because with Indiana, at least, Indiana starts with your federal adjusted gross income as its starting figure. And then Indiana has their own, they go on and do their own things, but they start with your adjusted gross income. So if you can't take a credit, well, it's going to benefit you, at least on your state return, to have a lower AGI and pay less state tax. Because just because something is a credit on your federal, it definitely doesn't mean it's a credit on your state, for example, your education. Refundable, non-refundable credits. So refundable are the ones in the payment section of your 1040 down there at the very bottom. And the biggies would be the earned income credit and the additional child tax credit, as well as the additional American Opportunity Credit. you will want to go back through the lecture notes and have a basic understanding between the American Opportunity Credit and Lifetime Learning. Who is eligible for each? How are the credits arrived at? What is the basic formula for that? Knowing that the Lifetime Learning Credit is you get 20% basically up to $10,000 in expenses, of qualified expenses. American Opportunity Credit, you get a dollar for dollar, assuming your income is high enough, or it's low enough you don't get the phase out, but it's high enough to where you get to take the credit. You get dollar for dollar up to $2,000, which is great, and then 25% for the next $2,000 as a credit to your taxes. And then American Opportunity Credit is only available for the first 4 years of your education. And you have to be at least part-time, so different rules that go along with that. You can go back into the Tax Act and look at the questions that they ask you to see which ones, and click yes or click no for some of them and see which one takes away the little X for the American Opportunity Credit or the Lifetime Learning Credit. I definitely want you to know the basics of the child tax credit, knowing that what age does the child have to be and under for you to be eligible for this, and how much do you get, and then what happens if you go over the phase out. So if we were to answer those questions, remember your child has to be 16 and under. Once they are over 16, even though you're still your dependent, you cannot claim the child tax credit. The child tax credit is $1,000. And then once you meet the phase out limits, you have to take off $50 for every 1,000 that you're over the phase out. Any phase out amounts I will definitely give you on the exam. I don't expect you to have those memorized as well. So any phase outs, because they do change every year, I don't expect you to memorize those. I only expect you to know the items that don't change very much from year to year, if at all. What are the things needed for the Child Independent Care Credit? How much are you allowed to take per child? How many children are you allowed to use for this credit? And then going back to week 5, when in my notes, I had discussed the Affordable Care Act, also known as Obamacare, and knowing, okay, who all has to have insurance. Remember, that is anybody you claim as a dependent, they need to have insurance, otherwise you will be penalized. You can opt not to claim them as a dependent, and then you won't be penalized, but then you don't get their exemptions or any other good stuff that may come along your way from claiming somebody. And then what's the penalty going to be if you don't have insurance, especially for this most recent tax year? And then it's a good idea to know what the penalty is going to be for 2015 and 2016, because the penalty does go up and go up quite a bit. I'll give you an example of something like this, where I give you a whole bunch of items that the taxpayer had throughout the year. And basically you're going to go through and I'm going to ask you, is this taxable, yes or no? Or is it a deduction, yes or no? Or is it a income but only partial? Or is it a deduction but only partial? Like for income being partial, one of the items maybe would be the Social Security. If you receive Social Security, well, yes, it is income, but only partially, and that all depends on your other income. Social Security may not be taxed at all, or it could be taxed, all of your Social Security income, up to 85% of it could be taxed. So if you made $10,000, there's a potential that $8,500 would be taxable as regular income. Or none of it could be, just all depends on what your other income is. So if I were to go through these, of course, wages, that's taxable. Qualified dividends, yes, it's taxed, but depends on your bracket how much you're going to pay in tax. Go back to class session 4 or chapter 3 to look at qualified dividends and who's going to pay tax on those and who's not, and what's the rate. Receive a new car as a gift, not taxed. That's a good thing. Win on The Price is Right, that is taxed, added as miscellaneous income. Dividends, yep, they're taxed at your normal rate. Interest, yep, taxed. Municipal bond interest, nope, not taxed. That would go there as a non-taxable interest on your 1040. Scholarship that you use for tuition, no refund of it, nope, not taxed. If you would get a scholarship and then get a refund because all of the tuition was paid for, and then you had some still extra left over, that is taxed. Workman's comp, nope. Workman's comp is not taxed. That's if you get hurt on the job and then you get paid money even though you're not working. Unemployment, that is taxed. Stock loss, that is deductible, but only up to $3,000. You cannot take a loss of $8,000 for the year on your taxes. You can only take a loss up to $3,000. The rest of it gets carried over into the next year. I'm going to have a couple of other examples like I did at the very top of this page. Brenda lives with her unemployed boyfriend, Tom. Tom has 2 kids. Kids do not pay over half of their own support. Brenda pays for Tom and the kids. Tom doesn't need to file. Exemptions, filing status, what can Brenda do? Well, technically, Tom's kids are his qualifying children. And by default rules, without any exceptions though, with default rules, Brenda could not claim Tom's kids. But there is an exception. If the kids are a qualifying child of somebody else, which they are for Tom, somebody else can still claim them if Tom or the kid's mother cannot claim them, or in this case, Tom could claim them, but he doesn't need to because he doesn't need to file. So the exception has been met that Brenda can claim Tom and the kids as her qualifying relative. So she can claim the 3 exemptions, not including herself. However, her filing status would be single because none of them are related to her. She could not claim the child tax credit because these are not her qualifying children. She cannot claim earned income credit either because they are not her qualifying children. It would be much better for tax purposes if Brenda and Tom were married. If they were married, then Brenda can claim the kids as her own and get child tax credit and the married filing joint, which is a higher deduction, and earned income credit. Joe lives with his kid and his girlfriend who makes $7,000 part-time and is on Social Security, disability, and he pays over half of her support. Exemptions, filing status. So we're talking about this from Joe's point of view, of course. Joe would be able to claim his kid. He would be able to claim head of household because he is claiming a relative of his. He cannot claim his girlfriend. She makes too much taxable income to be claimed. Remember, that's a very low threshold, only $39.50, $3,950. If you make over that in taxable income, you can't be claimed by anybody else. Again, if you're over the ages of either 18 or 23 and in school. Marry a full-time student, eligible for the American Opportunity Tax Credit, pays tuition of $3,000, lives with her parents, and is a dependent of them. So she's 19 years old. What is Mary's filing status? Would be single. Exemption she can claim? None. She can't claim herself because her parents claim her. What about the American Opportunity Tax Credit for the tuition? That's only available to Mary's parents. Even though Mary paid for it or had a loan in her name that paid for it, doesn't matter. If you're a dependent, you cannot claim the education tax credit. The parents would be able to claim it. A couple of things to remember. How much you're allowed. I just put these down here just as remembering. For the American Opportunity Tax Credit, lifetime credit. Max age for the child tax credit, you have to be 16 and under. You have to be 12 and under if you're still going to be receiving child dependent care, unless the individual is disabled, permanently disabled. And then I give some questions here. Tell me if this is a deduction above the line, below the line, credit, or nothing. So we go through these. Federal tax deduction. What I mean by this is, can you take a deduction on the amount of taxes that you paid in, that you have to pay on this year's return? And the answer is no. There is no such thing as federal tax deduction. The only thing there really is how much taxes you paid in, and then you get to take that as a credit, a refundable credit as taxes paid in. But there is no such thing like there is for state taxes. State taxes, you get to take that as an itemized deduction, but not for federal. Child care, so the parent can work, that would be a credit, child independent care credit. EIC, remember that stands for Earned Income Credit. That is a credit, therefore. Alimony paid. Alimony paid would be a deduction. It's above the line on the 1040. Child support received, nothing. Child support is not taxed in any way, received or paid. Unreimbursed job expenses, these are a miscellaneous itemized deduction, subject to 2% of your AGI, so therefore those are below the line. Home mortgage interest, another itemized deduction, therefore below the line. Credit card interest, no deduction, nothing. 3 hours of CPA tax work donated, no deduction. You do not get charity for donation of time or services, only of money, generally. Okay, I believe that is it for this review session. Again, that was probably about 30 minutes, so not too long. It should give you a good head start for the exam, and I hope you can do really well. Most of the stuff, again, is right here in the review document. You know everything in here. You should be pretty well off for the test. If you have any questions, make sure you email me. Otherwise, I will. We'll see you after spring break, beginning the middle of March, with IRAs and other retirement. And we will finish off this week, week 8.